I'm Tila. I'm from Cake Equity. I lead up our community and partnerships here in Australia. And I'm really excited to have Hanoze joining us today from the Assura Group to chat all things IFRS. Very important to note it's going to be Australian focused. So very much that's the space we're speaking to. For those who don't know about Cake, we are a cap table management software platform that helps startups accelerate their progress through motivating their teams through equity ownership. So yeah, super excited to hand over to Hanoze. The floor is all yours.
Thank you, Taylor. Thank you, Brendan, and thank you to the Cake Equity team for giving me this opportunity. Everybody on this call, good afternoon. I hope not to bore you to death over the next 45 minutes to an hour. And at the same time, I hope I don't make you puke your lunch in case you're having lunch while listening into this. So I want to talk a little bit very quickly about myself. So I am an auditor based out of Sydney. I've been personally, I originally come from India. I've been here in Australia for about 24, 25 years, long time. And most of that time, for the past 11 years, I've been working within Assura Group. So a bit about the Assura Group. It's a Sydney-based chartered accounting practice that specializes only in audit and assurance services, mainly audit, and mainly centered around financial statements audits. We do some other assurance services as well, but that forms a very, very small part of our portfolio. We are, by extension, an ASIC registered authorized auditing company. So we run our practice in the form through a company. So the company is registered as an authorized auditing company with ASIC or a registered company auditor. The firm currently has 3 owners, shareholders, directors, all of whom are directors in the firm as well. We are all individually RCAs, as in registered company auditors, as we are required to be. And between the 3 of us, I'm probably the spring chicken, relatively speaking. We have over 100 years of collective professional experience, most of it towards audit. We are supported by 2 senior managers, themselves having about 30 years of collective experience between the 2 of them. So the 5 of us are based in Sydney. And the remaining rest of the team are all based out of the Philippines. I don't know if how often you've come across that situation, but we were doing this since 2014. And we found a fair bit of resistance at that point in time, but COVID obviously normalized the way we conduct our business, and everybody now is working remotely. We use a paperless audit approach, so we don't have any paper audit files. That's in another lifetime. We also use a lot of cloud-based audit software and tools, so we don't have any hosted servers, etc. in our place. We've been through that journey, and it's now in the past. We have about, at any given point in time, about 150 to 200 audit clients, squarely within the small to medium-sized enterprises. And for some reason, not by design, more by circumstance, we sort of generally tend to have a 50-50 balance between for-profit entities and not-for-profit profit entities, mainly, and the industry's focus is financial services, small to medium-sized AFSLs, manufacturing, trading, distributors, software developers, and software service providers as well, charities, lots of them, ancillary funds, lots of them, member services organizations, and trust accounts. And within that, also, we have a lot of about 15 to 20, again, at any given point in time, clients who are subsidiaries, Australian subsidiaries of overseas parents. So a lot of parent entity reporting requirements and global consolidation reporting package audits. As in, we play a part in that. We don't audit the group consolidation. We are providing auditors' opinions on the Australian entities. In terms of extended affiliations, we are a member of an association, a global association called Alenial Global, which I believe is the 2nd largest association in the world of independent auditors and accountants. And we are also recently became a part of a network called BPM, both of them headquartered out of USA. So that's Assura in a nutshell, and I'm hoping based off the back of that I have reasonable experience in making this presentation. A few disclaimers. This session is meant for general purpose only. It's not meant to be taken up as any sort of financial advice. I've made some assumptions about the audience in terms of the presumed knowledge of the audience, but please jump in if I say something that you either think differently about or plain wrong or blah blah blah, and we'll try and resolve that in a couple of minutes time if we can. And members or the audience members should consider their own unique circumstances before trying to apply any of the principles or concepts that I mentioned in this conversation. And most importantly, please seek professional advice for specific accounting treatments and valuation applications. Okay. Just a couple of housekeeping things, I guess. The intention is to keep this a little bit of an interactive session. Not too much because I have certain amount of content that I need to go through. So Tila will probably interrupt me if some of you have questions, either through the chat box or raise your hand or something. And please excuse me, I'm more used to using Teams. So I'm a little bit new in working in Zoom. So Tila, please help me if I'm inadvertently ignoring someone.
Totally,
But
I'll butt in.
Thank you. And if I feel that there's those questions are veering away and taking away too much time from the presentation, I will request that we come back to the content, go through the content first, and then leave. The idea is to try and finish the content in about 35-40 minutes, and then leave the remaining time for questions if anyone has any. Okay, but this is going to be a high-level one. All right, so let's get into what are the suggested learning objectives here. Is to try and understand the scope and application of two accounting standards, which is AASB 2, share-based payment, and AASB 13, fair value measurement. Why these two topics? Because those were the two topics that Tila came to me and said apparently that's the feedback that is coming out of a lot of members interested in understanding this. So here we are. The second objective will be to try and get some key recognition, measurement, and disclosure requirements. Accounting standards are all about recognition. When do you recognize something? How do you measure it? And what are the disclosures required? And also try and recognize some challenges and best practices in the implementation of these two standards. Okay. So let's go with the flow on this one. So the first thing, I'll spend a bit of time on share-based payments first. Fair value, in terms of this presentation, I'm spending more time on share-based payment than on fair value measurement. I've made that assumption myself. I think that this is probably more of interest to a lot of the audience, but I apologize if I'm incorrect. So AASB 2, share-based payment. What is the purpose of that standard? It explains how accounting explains the accounting fundamentals for any transactions in which goods or services are received by an entity, but instead of paying cash, you're paying either equity instruments or cash linked to equity instruments. So how do you account for those? That's the purpose of this standard. Who is it applicable to? Both public and private entities preparing general purpose financial statements or special purpose financial statements that are purported or advertised or disclosed as meeting the recognition and measurement criteria of accounting standards. Now, this is here the first assumption I've made in terms of presumed knowledge of the audience. I've assumed everybody knows the concepts of GPFS, GPFS SD, and SPFS. If anyone wants me to read those out, spend a couple of minutes on explaining that, please let me know. Otherwise, I'll just move on. Okay. Okay, so any entity that prepares general purpose accounts, whether they are whether they are simplified disclosures or even full disclosure, tier 1 or tier 2, needs to follow this standard. What is the scope of the standard? Obviously, any equity settled transactions or cash settled transactions or transactions where the supplier or the entity has a choice of one of these two settlement methodologies. The next slide talks about, now some of this is definition heavy, so please run with it, and it's important that we go through these definitions. So what is an equity settled share-based payment transaction? It is, as stated there, a transaction where an entity receives goods or services and pays in terms of its own equity instruments instead of paying cash. Or it receives goods or services but has no obligation to settle the transaction with the supplier. As in settle again in terms of by cash, by paying cash. So that's an equity settled share-based payment transaction. On the other hand, a cash settled share-based payment transaction. Obviously, as you saw, it's a bit of a mouthful to use these terminologies, but it is what it is. It is what it is. A cash settled transaction is one in which an entity acquires goods or services by incurring a liability to either transfer cash or other assets based on the price of an equity instrument. So I might buy some goods and services, and I might say, instead of paying just whatever X dollars of money, I'll say I'll pay you X dollars based on the movement in my share price going up and down. Okay, that's a cash settle. At the end of the day, cash is still paid, but the amount of cash paid is dependent on an equity instrument behind the scenes. Okay, so it's important to just understand these two things here. The first concept is recognition. When do you recognize a share-based payment? You need to recognize a share-based payment when the entity obtains the goods or services that it has either received or acquired. And it can happen either at a point in time or over a period of time. So I might buy goods or I might receive some services either at a particular point in time or over a period of time. Example, when very often when you're issuing share options with vesting periods, the entity is receiving those services over a period of time. But sometimes, just to complicate matters, when those options are granted, the vesting system is such that some vest immediately, some vest over a period of time. So those that are vesting immediately are obviously being received. Those goods or services are being received at that point in time, whereas the rest are received over a period of time. That's a difference also that people need to understand. How do you recognize the share-based payment? Few ways of doing it. It could be an increase in equity. If it is an equity settled transaction, it could be via an increase. So one side is recognizing the expense. We'll talk about how to measure and measure the expense. But the point is, one side is usually either an expense. So you debit an expense or an asset if you're acquiring an asset. And the other side is, if it's an equity settled transaction, it goes into equity. If it's a cash settled transaction, it goes into liability. So it's one of the two. Either the credit goes either on the liability side or in the equity side. And it depends on what kind of settlement mechanism is put in place. And as I said earlier, if the goods and services received do not qualify as assets, they are recognized as expenses. All right? So far, so good? Okay, I'll keep going. How do you measure the transaction? So we've understood, okay, well, you might come to a point and say, okay, I need to recognize this transaction, and I know how to do it as well. But now the next thing is, how do I put a dollar amount to it? So the dollar amount is calculated as follows. For equity settled transaction, you estimate the fair value of the goods and services received. So if you received a Porsche car for some reason, and you want to pay in shares, if you are so inclined, the value of the Porsche car determines the value of the transaction. Obviously, the underlying assumption is that you can put a fair value to the goods and services received. However, if the fair value of the goods and services received cannot be estimated reliably, then you flip it around and you try and estimate the value of the equity instruments that have been issued. And that forms the dollar amount that you need to recognize the expense or the asset and the liability or equity, whatever, all sides of a journal entry. For cash settled transactions, obviously the fair value is the value of the liability that is incurred. Okay. The other thing to note between these two things is for equity settled transactions, normally, once you've measured it, you don't need to remeasure it again. Whereas in a cash settled transaction that might be going on, that might be live for a period of time, you need to revalue it at every reporting date, be it every quarter, every 6 months, every year, whatever it is. And I've put some examples of those kind of transactions. Equity settled transaction, share employee stock options is a very common one. For cash settled transactions, it could be share appreciation rights. Okay. How do you measure in cases where cash alternatives are provided, where the counterparty has a method as in the seller or the vendor of the goods or services has a choice as to the settlement method? Again, you try this is where things start getting complicated. If the entity in this case, as in the receiver of the goods and services, has granted what is known as a compound financial instrument that has a debt and an equity component. The debt component is valued as a liability because it will be settled in cash, and the equity component will have to be valued. Whatever is the difference between the two will be assigned to the equity component. Okay, this gets complicated. I'm just putting it out there. Maybe this is not the forum to go into too much depth at this point, but please be aware that this also can happen. Again, the next thing is for cash, where there are cash alternatives, where the entity receiving the goods has the option. In that case, the entity has to decide whether the present obligation is to settle in cash or otherwise. If it is to, if the answer to that question is yes, it is recorded as a cash settled transaction. If the answer is no, then it is considered to be an equity settled transaction. So in other words, if it has the choice to not pay cash, obviously it is considered to be an equity settled transaction. All right. Again, the accounting standard is providing all of these options, but the reality might be very often that it's all very often an equity settled transaction. What are the disclosures required here? The disclosures required are you have to include narrative description, enough narrative description about the nature and extent of the share-based payment arrangements that existed during the period, not just at year end, during the period. I'll say typically a financial year. So any share-based or payment arrangements that went through during the period, you need to provide adequate information around that. You need to also add enough information in there to assist the reader understand how fair value of the equity instruments, underlying fair value of, fair value of the underlying equity instruments was determined. You also need to include separately the impact of those share-based transactions on the P&L. The P&L obviously is for the period, and the balance sheet is as at balance date. I'm intentionally using the words profit and loss statement and balance sheet because we still seem to be living in that era, even though the technical terms have changed. And yes, the accounting standards allow you to continue using the old terminology as well. But it's a bit of a mouthful to say statement of, there you go, I lost myself straight away. Statement of profit or loss and other comprehensive income and statement of financial position. Blocky and SFP. That's what we use in our firm rather. What are the main challenges that might occur in share-based payments? The main challenge is estimating fair value of the underlying equity instruments. That is very often the main challenge in share-based payments. If you're using various models like Black-Scholes, Monte Carlo, binomial model, those mathematical models themselves have multiple variables in there. I think the Black-Scholes model has about 4 or 5 variables that you need to know, with one of them being the shape or the value of the underlying equity share, and then volatility and this and that and blah, 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 discount rate and all of that sort of stuff. So a lot of assumptions and estimations to make in there. And obviously with all of that, complexity increases, especially when there are, in the case of non-employee transactions, because the value of the goods and services, etc., might be not straightforward, etc. Okay, these are the main challenges that I've come across. Now, that's my content as such that I wanted to motor through for share-based payments. And what I want to now do is, for the next 5 minutes or so, share some examples if that helps. Is that okay? I'll just pause for a moment before I go into the examples. Any questions, Tila? Or is everybody glazed over? Are we sure everybody's awake?
I'm sure they're awake. No questions at this stage in the chat, but in saying that, if anyone does have any that they want to pop in, please go forth and do that, and we can tackle them now.
Excellent. Okay. Now for an example. Now, obviously, there are lots and lots of examples of share-based payments, but I chose employee share options as an example because that would probably be one of the most topical ones around, hopefully, for the audience that's listening in. So the first example is issue of employee share options by the entity itself. And I've just made some variables and I'll talk about them. So I've said known or calculated variables. We are issuing 1,000 share options. Sorry, not issuing, granted, which are vesting over 3 years in equal proportion. So nothing vesting on the date of grant, but everything is vesting in a future period. And I've said here for this example, fair value of the option at grant is $2. Now, this is given in this example. Now, trying to arrive at the value of the share option itself will be one of your, will involve a significant amount of estimation and assumptions on your part. Please bear in mind, share options can never be worth more than the underlying share. Please understand that. So if your maths is working out, is throwing out a number where the value of the share option is higher than the value of the underlying share, equity share, you're probably more than likely making a mistake. Okay. So the example here is I just want to try and say, okay, how do we, what's the expense calculation, the journal entries of the different dates and potential challenges. I've already spoken about potential challenges, but let's go to the next slide. So just bear in mind, this is employee share options issued by an entity itself. And the reason I say that is you'll see it later. So the total expense, now this is, you measure it. The total expense is the number of shares, number of share options granted, which was 1,000. The fair value was considered to be $2. So the total expense is $2,000. What is a journal entry that you record at grant date? The answer is none. Because as I mentioned in this example, there are no options vesting on grant date. Now, in reality, very often some do vest on grant date itself, but in this example, I've assumed that it's not. All right. Then the next set of entries is at every vesting date, which will hope in this case is every annual anniversary, you post an entry where you debit expense in the P&L and you credit a share option reserve in the equity section. So this is equity. Expense in the P&L, share option reserve in the balance sheet. You do that at 3 times. At the first anniversary, second and third anniversary. Okay. So bear in mind, no cash has changed hands, but you're recognizing the expense in a periodic manner because the service from an employee has been received over that first year, then the second year, and the third year. If the employee chooses to exercise those options, as in go ahead and buy those underlying equity instruments at the strike price that is mentioned within the share option agreement, obviously at that point in time, there is money coming into the company and the entry that is posted would be effectively debit cash, credit share capital because shares are being issued. All right. Now hold the thought for a moment. Now what happens at and we'll come to that and I'll talk to you a little bit, start again. I'll go into a little bit more detail a bit later, but the next line down is, what is a journal entry at each option expiry date? So when options are either exercised or they expire because of the passage of time, if you think about it, the share option reserve associated with those options is no longer required to be carried forward in the balance sheet. So the accounting standard says you may, but you don't necessarily need to do that. You may reverse the option reserve. You don't, as in release the option reserve to that extent back into retained earnings. You don't reverse the original expense. The expense has been incurred in the past, but now the option reserve that is sitting in your equity section is no longer required to whatever extent it has been. Either those options have expired without being exercised or they have been exercised. So you can release that reserve back into the retained earnings via this entry, which is debit option reserve, credit retained earnings. What does this do? Are you, and again, I repeat, you're not, the accounting standard does not mandate that you need to do this. So you can have a share option reserve sitting in a balance sheet forever. But if you're doing that, if you think about it, what you're doing is you're potentially reducing the pool of retained earnings available for distribution as dividends or to shareholders. So you want to try and release it into the retained earnings. Does that make sense? I'll again just pause there for a moment and see if anyone has any specific questions on that bit. Okay, I'll keep moving on. Next example. What if the employee share options are issued by another group entity? And in this case, I'm assuming it's the parent entity, a parent entity further up the chain in the group. And that happens very often, especially here in Australia. We might have foreign parents that are listed elsewhere in the US, NASDAQ, wherever else have you. Employees are working within the Australian entity, and there are share options issued where the underlying security is the for equity instruments issued by a listed entity or something, a parent entity further up the group. Again, the same thing, I'm using the same example, 100 share options granted, vesting over 3 years equally, and just for the sake of this example, I've said $2 again. Again, the same thing, we'll go through all of these discussions, but here there are two scenarios. Let's imagine for a moment that the subsidiary does not need to settle with the parent entity or the entity that's issuing these share options. Or number two, the Australian subsidiary is required to settle with the parent entity or group entity that is issuing this thing. So I'm intentionally splitting it out into two. So here, in this case, where the first example is where it's not settled by the subsidiary, okay? In that case, the total expense is again calculated the same way. It's $2,000 over 3 years. In this example, no entries posted at the on grant date because there are no options that are vesting on grant date. Then here, this is the first change. At each vesting date, you're debiting the expense and crediting the share capital account directly. Now, there might be some intervening accounts that are posted there for timing differences, etc. But ultimately, this is the entry that will be posted. Why? The reason is because the subsidiary is not required to part with any cash on account of this service being provided to it by its employee. The parent entity is committing to issue shares or share options in its own books to that employee who works at the subsidiary level. So effectively, it is considered to be a capital infusion from the parent entity to the subsidiary entity. And that is why effectively the entry posted is debit expense, credit share capital. as I said, there might be intervening clearing accounts used in between for timing differences to manage process, etc., etc. But ultimately, this is the impact of the entry in the books of the subsidiary. Okay. Then, if again the same thing, either those options are exercised by the subsidiary employee or they have expired, no further entries need to be posted in the subsidiary, because all the subsidiary needs to do is recognize the expense. Because the other entries, if I can go back, these entries of debit, cash, share capital, or option reserve, retained earnings are now recorded in the books of the entity that is issuing those share options. Again, I will pause and let everyone just absorb that if they don't already know. Okay, I'll keep going. So in this case, not settled by the subsidiary. Second case, it is settled by the subsidiary, where there is an expectation that the subsidiary will pay for it. In that case, again, this expense is recorded on the same date, no journal entry at grant date, but at each vesting date, a liability needs to be recognized. And the liability is to a group entity. Okay, in this case now, if I'm using the parent entity, I should have used the word payable to the parent or parent entity payable or something like that. But at the end of the day, it's a liability that needs to be somehow settled between the two entities. However, again, because of the fact that the share options have not been issued by the subsidiary company on exercise date or option expiry date, there are no further entries to be processed. Again, the expense is recorded only the expense needs to be recorded in the subsidiary books, and that's it. Now, in reality, things might be more complicated than this. There might be agreements put in place between the subsidiary and the parent entity, and that might have an impact on the way some of these entries are posted. But conceptually, and for the purpose of this example, this is what can be done. Okay. What would be the example disclosures for share issue options? Now, again, there are quite a lot of things here as per the accounting standard. I've just put it in there as a bit of a dump. People can have a look at it. It's essentially with the same concepts as earlier. What are the general terms and conditions with each arrangement? And for each exercise, for each date here, when at the start of the period, at the end of the period, grant date, exercise date, forfeit date, blah, blah, blah. A lot of information in point B, point C, and point D. But at the end of the day, the reader needs to understand how much of these instruments were issued. Because bear in mind, from an investor's point of view, all of these instruments lead to dilution of existing shareholders, but at a future date, because they might have a long vesting period. Okay. That's my presentation so far on AASB 2. Again, just a quick pregnant pause in case there's any questions coming up.
Either very shy bunch or your information is just landing perfectly, Hanoze.
It is landing perfectly. I completely
it's...
understand my own presentation.
Yeah, I think we're still looking all good in the chat.
Okay. All right. So I'll go to the second part of the presentation, which talks about AASB 13, fair value measurement. Again, what is the purpose of the standard? It's meant to provide a definition of fair value. We keep hearing the term fair value ever so often in accounting standard terms. So this, a few years ago, whenever this this standard came in, prior to this standard coming in, fair value was defined in multiple places in multiple accounting standards. And while usually the definition used was pretty much the same, the point was there were instances where different definitions crept in inadvertently, and that created confusion. So the standard setters in their wisdom decided to create a separate accounting standard to define fair value and provide provide a single framework. So in one place, you get the framework of what is fair value and how to apply it, and also what disclosures are required around fair value. When is it applied? It is applied when any other accounting standard refers to fair value. Says, oh, you need to do this as you need to recognize this asset or liability at fair value. The word term fair value will not be probably defined in that particular standard. You need to come back to this standard. But at the end of the day, I guess we are all professionals here, and there's always an if and but and exceptions. So whoops, sorry, I think I might have jumped here. Okay, here we go. I think I have mistakenly deleted a slide. Just realized that, but that's okay. I have mistakenly deleted a slide. Anyways, now there are exceptions to it, and let me just make sure. So where does fair value measurement not the provisions of this particular standard not apply? There are three exclusions. One is in AASB 2 itself. In some instances, fair value, what is fair value for equity settled transactions, etc., is defined in that standard. So to that extent, here it doesn't matter. You don't come back to this standard for that particular situation. The other is in the case of AASB 16, which is leases. What might happen is, again, how do you value the lease liability, etc., and the right of use asset? It's detailed in that standard itself. You don't refer to this standard for fair value calculations when you're doing them for AASB 16 purposes. And the last place is for AASB 136, which is impairment of assets. There are some very similar sounding terms like recoverable value, which is not fair value. Recoverable value in simple terms is defined very often as fair value less costs to sell. Okay, so typically recoverable value will be less than fair value. So please bear that in mind. Then the other exceptions as well, disclosure exceptions. So the disclosures in this particular standard do not apply when you're talking about disclosures for AASB 119 employee benefits, especially for plan assets, etc. I would doubt that a lot of, super fund assets will have super funds will have this issue, but not so much most other entities, business entities in Australia, because an overwhelming majority of them will be paying super on behalf of their employees and taking the risk of superannuation off their books. So as long as they keep paying their superannuation SGCs or salary sacrifice as they're required to, the liability of those plan it shifts somewhere else. It does not sit on their own books. We do have a problem, especially in the US, where you have these 401, I think they're called 401k asset plans, where those benefits still sit on the books of the employer. And if someone's old enough to remember that, General Motors collapsed in some shape or form because it drowned in the weight of those plan liabilities. So it had to restructure significantly. The other place where disclosures don't apply is assets for which, as I mentioned, recoverable value, which is fair value less costs of disposal. Okay, so these are a few exceptions where this standard or the terms of this standard don't apply. So what's the definition of fair value? Now, intentionally I have put an emphasis on those words that are marked in bold and italicized, and I'll talk about them a bit later. So the definition of fair value, I'll read it out ad verbatim. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at measurement date. So there's 1, 2, 3, 4, 5, and 6 terms in that definition that I have intentionally highlighted. And I'll talk about them a little bit separately as I go along. Okay. So the first thing is fair value is assigned to either a particular asset or a particular liability or a group of assets or a group of liabilities. And by extension, it means that when you're determining fair value, you need to consider the condition of the asset, the location of the asset, restrictions on the sale and use thereof, and even the liabilities on the flip side. The other thing is it is meant to be, it is assumed that the transaction is going to be an orderly transaction. So distressed sales or forced liquidation, prices achieved during distressed sales or forced liquidations would not be considered to be an orderly transaction. The other concept or assumption that is made within the fair value concept is that there exists either a principal market or if a principal market doesn't exist, the next best, most advantageous market. So these are some theoretical concepts that you just need to understand. There are practical applications as well, but just be aware of these concepts. The next thing to consider is the appropriateness of the market participants. Again, that is a reflection on what kind of assets. You can't sell a Formula One car to people like you and me who want to use a car to drive in the street, go to work, commute every day. So the market participants will be, if you're trying to measure fair value that way using that population of market participants, you are missing the point. Okay, so please bear that in mind. So the appropriateness of the market participants and the assumption that they always act in their own economic best interest. So a buyer will always want to get the lowest price, a seller will always want to get the highest price, and the reality lies somewhere in between. When we talk about price, it could be either directly observable, as in it's very easy to find prices, stocks, share prices in a stock market, very easily observable by the minute, if not in microseconds. Or it could be estimated using other valuation techniques. Okay, so these are all these 4 or 5 items that pull together, that come together in the fair value concept. How would you apply it? It's 12:40. Sorry, it's 1:45. Taylor, or just past it. I'm just making sure that my watch here is not going too far ahead. Okay, application to non-financial assets. So this takes into account the market participants' ability to generate highest and best use of the asset. What that means is you determine fair value assuming that the asset is being used and it's at its highest and best use scenario, or it is selling it to a party who will end up using it for highest and best use. How do you apply it to liabilities and an entity's own equity? Fair value of the liability assumes that when you transfer the liability is not being extinguished, as in you're not paying cash and extinguishing the liability. It assumes that the liability will still be there for whatever the remaining 2 years, 3 years, whatever it's there, especially in trading of bonds, for example. When you're trying to fair value bonds, you assume that the bond is not going to be extinguished until its date that it's meant to mature. Similarly, the same thing for equity instruments as well. What are the different types of valuation techniques used? So again, the standard defines what valuation techniques can be used. It says that the entity shall, as in it's mandatory, there's no choice here, is mandatory to use valuation techniques that are appropriate in the circumstances and for which sufficient data is available and to measure fair value, And what you're trying to do when you're trying to establish fair value is you're trying to maximize the use of observable inputs like share prices on a stock market, as opposed and minimizing the use of unobservable inputs, like for example, the share price of an unlisted small PTY company, or maybe the share price of Assura Group. You don't have visibility of that. Okay, so just bear that in mind. Again, this is another concept that's put in the fair value measurement standard. What are the different types or techniques that they can use? There's a market approach. That's basically three main approaches: a market approach, a cost approach, or an income approach. And you could use either just one of these three methods or multiple methods and a combination of it. At the end of the day, you arrive at a fair value, which might be over a range rather than one single dollar amount. What is a market approach? The market approach uses, as the name suggests, it uses prices that are easily available through various markets. So share prices on a share in an exchange, very easily observable. Cost approach, it reflects the amount that would be required to replace the asset that we are trying to assign a fair value to. So for example, if possible, a used car, a 3-year-old used car typically might have depreciated in value by about 30% or so. Okay, that's what the fair value is. Now the replacement cost is much higher. It can be much higher if you're going new. But then again, in that situation, what you're doing is you're changing the parameters. So please bear in mind what you're doing there. But the point for the purposes of this standard, the cost approach refers to the cost of replacing the asset if a market value is not easily observable. Then there is an income approach where what is done is the future income, estimated income that is generated from that asset is discounted back to a single value in present value terms. So these are the three main approaches. Three approaches allowed under the standard. Okay, and you can use one or a combination of the two or of the three. Types of fair value. Now it's starting to get dry, isn't it? I'm starting to fall asleep. I need to wake up. Okay. Okay, fair value hierarchy. You have again three levels. Level 1 is quoted prices in active markets. The third one, level 3, is on unobservable inputs. And between the two, you conveniently have level 2, where there are observable inputs, but other than level 1. What does that mean is you could have options, etc., where you're not able to, they might not be listed. There are obviously share options that are listed share options or securities, whatever of that sort. So that's easy to value, but then you use other methodologies to arrive at level 2 observable inputs if level 1 or level 3 is not easily available. What are the disclosures required? For assets and liabilities that are measured at fair value, you need to include in the financial statements the valuation techniques and inputs that have been used to develop those measurements. You need to have enough of a story to make the reader understand how you have arrived at those fair values. And for recurring fair value measurements, where you're using where movements go up and down and affect the P&L, you need to include very clearly what the impact of those fair value movements were for the period, for the reporting period, the quarter, half year, full year, whatever it is. Okay. And in some instances, most of these instances, fair value movements go through the P&L, but in some very, very, very minor, very specific instances, fair value movements may be able to go through other comprehensive income, which is below the profit line. I think if I mistake not, one of those situations is in revaluation of fixed assets. If I remember correctly, that fair value, assuming those fixed assets are held, they are not held for sale. In those instances, say property valuations, those property valuations might flow through as other comprehensive income and not hit your profit line item. However, if the property is being held for sale or it's being used as an investment property, then that'll hit the P&L. So just an example there. What are the challenges? Now, there are quite a few challenges in this, and I've intentionally split it up into two separate slides. But it can but one sort of leads to the other, and the next, and the next, and blah blah blah. The first thing, obviously, is market inactivity or illiquidity. So if there doesn't exist a ready market for the asset or liability that you're trying to transfer, that creates a lack of observable transactions. So you don't have any precedents that you can rely on, which then has an impact on whether you have level 1 or level 2 inputs, which means you invariably, if you don't have enough level 1, level 2 data inputs, you effectively have only no option but to go towards level 3. The moment you go through level 3 fair value inputs, you're including more estimates, more assumptions, etc., and therefore it becomes more subjective, more complex, more uncertain. And the list just keeps going on that way. So you might also have a problem in determining who the market participants are to determine fair value, and that might create its own issues. Or the market keeps changing very often. So you might have, for example, in share prices, if the share prices fluctuates a lot, that creates challenges as well, because what is fair value at a particular point in time might not be considered to be fair value a week later because the share prices have moved too much. Then in the case of fair valuation of non-financial assets, determining what is the highest and best use, and that can become quite complicated because you have different opinions of different people. There are numerous compliance and disclosure requirements here, and they can become complex. And because of that, if your financial statements, invariably, someone like yours truly is required to be skeptical and challenge your assumptions to see whether they withstand scrutiny. We auditors would probably be a little bit more friendly than regulators like ASIC. And please understand asset valuation, into which the fair value concept falls in. Asset valuations are always one of the focus areas for ASIC, the other one being revenue recognition. Okay, so these two areas are always ASIC issues a market what's it called? A market disclosure statement. That's not the right word, but it puts a media release. It puts out a media release every year just before the reporting season to say it's looked at the previous year's audit files, it's done its review, blah blah blah, and it identifies which are the focus areas, and it helps preparers and auditors pay more attention to those areas. And invariably, it doesn't. More often than not, the 4 or 5 areas almost constantly keep coming up over and over again, with these two being revenue recognition and asset valuations always there. You can bet your bottom dollar that it's always going to be there. Best practices for fair valuation: don't try and do it in-house. Use external independent valuers. Document all your valuation inputs always. That's how there are a lot of estimates and assumptions involved. Make sure that you document them. Then at least, even if you've got them wrong, you have something to hold on and say, these are the assumptions, we stress tested them. The reality worked out to be something different because you're actually crystal ball gazing anyways. Regular review of the assumptions, especially if you have volatile markets and volatile price movements. Oh, that was abrupt. I completely forgot that was my last slide on that particular issue, and which brings me to the end of my content presentation. And if I haven't bored you to death, and if you still want to wake up and ask me questions, I'm all ears. Now, if I don't know the answer to the questions, which can happen, because I'm not Mr. Know-it-all, even though my wife says I portray myself as Mr. Know-it-all, especially my daughter as well, I'm not. So please give me the grace. If I don't know the answer to a question, I'll note it down, or maybe Tila can note it down, and I promise to get back to you within a day or two with that. But I'll need your contact details to contact you again. So open to any questions, everyone.
Perfect. Thank you so much. I feel like it's a very complex topic, and I think you like really loved how you laid that out, like in terms of like the steps and the breakdowns and the different parts. So that was, yeah, really appreciate it. Thank you,
Thank
Hanoze.
you. Thank you. Thank you.
We do have one question in the chat from Davina, which is to us at Cake. And Brenda, I don't know if you know the answer to this one. There is a new feature in our platform under equity compliance called IFRS 2/SBP. Could you explain a little bit more about how to use this feature? It's from Davina.
Yeah, definitely. Yeah. Thanks for the question. So yeah, thanks to Noz for that. That was really, really helpful, even for myself. And specific to where Cake has developed, but we were talking about equity related transactions with IFRS 2, and that's something that Cake's made a lot easier for the finance teams at scale ups in Australia. And we have allowed you to do all the expense calculations for a given financial period, expense those. It'll show you previous, when then you can run it again in the next financial period. It'll do the math and show you how much is basically at what stage, and in a cumulative sense, all of your stock options or equity you've issued to your employees is to be expensed, and at what stage. So yeah, I'm happy to kind of talk with you directly, kind of explain how that works. And then we actually allow it for different methodologies. So we have straight line method, tranche based, and so there's just different ways to model it. I did actually have a question for Hanoz related to that, specifically around, because we're able to do all the calculations for the journal entries post you guys, it's post the customer or the client being able to determine the fair value of the equity.
Mhm.
And you mentioned at the start that you do the grant, you can determine the fair value, and then that can be an ongoing figure that doesn't need to change. Is that what you mentioned, or is
For that tranche of
for
options,
for
for
that
that tranche of options,
for that?
once you measure it, you don't need to remeasure it. All you do is you figure out over what period of time that
Mhm,
total expense is meant to be recorded. Because
mhm,
bear in mind, if there's a vesting period in which is most often the case, if it
mhm,
vests 1, 2, or 3 years later, it's not considered to be an expense right now
mhm,
because the entity has not received the underlying services. All it
mhm,
has done right now is it has committed to issuing, it has granted those options. Bear in mind, it's not issuing the underlying uh, security, underlying share. It's just granting the options with the intention saying, okay, uh, uh, the share price might be worth $20 right now, but these options allow you to strike and buy options, buy the shares at $15, but not today, in a year's time. So what it
mhm,
does is it aligns, it in a way, it forces the people to say, okay, I better work my backside up to make sure that I do everything possible. If anything, I know what my share price is going, what my cost is going to be. I want the
mhm,
share price to go up so that when I
mhm,
purchase those shares, when I exercise the options, if the options are still in the money, if they vest and they're still in the money, I will definitely buy those shares at 15 because I know the value by that time might be 25. So I'm
mhm.
straight away $10 ahead.
Yeah. And then the other question I had was around IFRS 13 and
Hmm.
determining the fair market value for, in this case, options again, or
Hmm.
employee
Hmm.
equity.
Hmm.
Um, there's obviously different methods. You mentioned Monte Carlo,
Correct, correct, correct,
Black-Scholes, and
correct.
at the end there you said best practices were to have an external evaluator or external
Yep,
firm do that. Is that
yep.
for arm's length reasons, or is it just that it gets a little cumbersome to do internally for most companies? Or
Combination of the two, Brendan. Combination of the two, and other things. Very often, the ability to do all of those models, if you can realize, they're more by extension, they are level 3 inputs because you don't have uh, the shares might not be issued in an open market. So you don't have level 1 inputs. You probably don't have level 2 inputs. So you are down to level 3, and you're using these models to try and determine the value of those share options.
Mhm.
And each model then has its own unique set of parameters. There's always a slightly different way of looking at these things.
Mhm.
And in all of those, like I said, for example, in Black-Scholes, there's a volatility factor. How do you determine that? It's sometimes almost like sticking your finger in the air. Okay, I think it's going to be this much, and blah blah blah. And you're making estimates. So to withstand scrutiny, if you have an external independent person doing the valuation, you can probably say, look, I provided them all the information. They are the experts. This is what they believe. And that's what we have used. So it covers your track. It reduces the liability in case something goes pear-shaped in the future.
And one other question was for Australian companies, are you finding that is it just kind of typical to be doing these stock-based compensation reporting on a yearly basis, or is there a point where expectations get to quarterly, or what's kind of like for private companies?
Sorry, sorry, I missed a bit. What was the question again? Did you say expense recognition?
Yeah, for the expense recognition,
Yep.
It seems like you mentioned that yearly seems to be the most common. Is there a point where it becomes more frequent, or?
No, I haven't seen that. But it's usually annually. And usually it's very much in sync. Quite often it's in sync with the financial year end. So it just becomes the calculations become a little bit easier to do.
Yeah.
If they are synchronized with financial years.
Cool. Sounds good. Thank you.
Thank you.
Yeah.
Taylor, any other
Lovely.
questions in all of that time?
No, I think everyone is
Has gone to
keeping in their
sleep.
questions themselves or don't have any because you explained it so well. So really appreciate your time, Hanoze, and
No
appreciate
problems.
everyone who's jumped on the call to have a listen. As I said, this will be recorded or has been recorded, and we'll send it out so you can go back through it. And Hanoze, we can chat offline about your comfort levels in terms of sharing the slide deck. And
I will send it to you. I'm happy to
perfect.
send it to you via email. I just
Great.
realized, like I said, I think there's a slide that I've deleted, so I'll just bring that back in and then
Love it.
send it to you. Okay, give me about
Perfect.
half an hour or so.
Love it. Yeah. So we'll ship that out along with the recording. It'll take us longer than half an hour to process the recording, but yeah, we'll get some info out to everyone who's come along and those who couldn't make it within the next sort of 24, 48 hours. And Hanoze has his email up on the screen. So if you do have any other questions, you want to reach out to the Assura group, please email him. It will also be in obviously the slide deck when we share it. And then, yeah, myself and Brendan will be reaching out to everyone who's attended or registered so that, yeah, we can follow up. And if anyone has any other questions, we can answer them then too. But conscious of time, we should probably wrap it up. So thanks, everyone.
Thank you very much. Thank you, everyone. Have a good afternoon and all the best.
Bye.
Bye for now.